Welcome to our video on investing in bonds. In this video, we will cover everything you need to know about bonds, including what they are, how they work, and why they are an important investment option. Bonds are a type of investment that allow you to lend money to a company or government in exchange for regular interest payments and the return of your principal investment at the end of the bond term. Bonds can be a great way to diversify your investment portfolio and generate steady income, but they also come with risks and considerations that you need to be aware of. In this video, we will provide you with all the information you need to make informed decisions about investing in bonds. So, let's get started. There are several types of bonds available for investment, each with its own unique characteristics and risks. The most common types of bonds include government bonds, municipal bonds, corporate bonds, and high-yield bonds. Government bonds are issued by the federal government and are considered to be the safest type of bond investment. They typically offer lower yields than other types of bonds. Municipal bonds are issued by state and local governments to fund public projects such as schools, roads, and hospitals. They are exempt from federal taxes and may also be exempt from state and local taxes. Corporate bonds are issued by companies to raise capital for business operations. They offer higher yields than government and municipal bonds, but also come with higher risks. High-yield bonds, also known as junk bonds, are issued by companies with lower credit ratings and offer the highest yields but also come with the highest risks. It's important to understand the risks and potential rewards of each type of bond before making an investment decision. In the next segment, we will discuss how bonds work and how you can make money from them. Bonds work by allowing you to lend money to a company or government in exchange for regular interest payments and the return of your principal investment at the end of the bond term. When you invest in a bond, you are essentially buying a debt security. The issuer of the bond agrees to pay you a fixed interest rate, also known as the coupon rate, for the duration of the bond term. The bond term can range from a few months to several years, depending on the type of bond and the issuer. At the end of the bond term, the issuer is required to pay back the principal amount of the bond to the investor. Bond prices can fluctuate based on changes in interest rates, inflation, and the creditworthiness of the issuer. If interest rates rise, the value of existing bonds will decrease, as investors can earn higher returns from new bonds with higher interest rates. Conversely, if interest rates fall, the value of existing bonds will increase, as investors are willing to pay more for the fixed interest payments. It's important to understand the risks and potential rewards of investing in bonds and to diversify your portfolio to manage risk. In the next segment, we will discuss the benefits and drawbacks of investing in bonds. Investing in bonds can offer several benefits, including steady income, diversification, and capital preservation. Bonds can provide a reliable source of income through regular interest payments, which can be especially attractive for retirees or those seeking a stable income stream. Bonds can also help diversify your investment portfolio, as they tend to have lower volatility than stocks and can provide a hedge against inflation. Additionally, bonds can offer capital preservation, as the issuer is required to pay back the principal amount of the bond at the end of the term. However, there are also drawbacks to investing in bonds, including lower potential returns, interest rate risk, and credit risk. Bonds typically offer lower returns than stocks, which can limit the growth potential of your portfolio. Interest rate risk refers to the risk that the value of your bond investment will decrease if interest rates rise, as investors can earn higher returns from new bonds with higher interest rates. Credit risk refers to the risk that the issuer of the bond will default on their payments, which can result in a loss of your principal investment. It's important to carefully consider the benefits and drawbacks of investing in bonds and to consult with a financial advisor to determine the best investment strategy for your individual needs. In the final segment, we will provide some tips for investing in bonds. If you're considering investing in bonds, here are some tips to keep in mind. First, consider your investment goals and risk tolerance. Bonds can be a great way to generate steady income and diversify your portfolio, but they also come with risks. Second, research the different types of bonds available and their associated risks and rewards. This can help you make informed investment decisions. Third, consider investing in a bond fund, which can provide diversification and professional management. Fourth, monitor interest rates and inflation, as these factors can impact the value of your bond investments. Finally, consult with a financial advisor to determine the best investment strategy for your individual needs. Investing in bonds can be a great way to generate steady income and diversify your portfolio, but it's important to understand the risks and potential rewards before making any investment decisions. We hope this video has provided you with the information you need to make informed decisions about investing in bonds. Thank you for watching.